Have you ever wondered if you could just take the market's temperature, with a single number that captures its entire mood? Well, you can. It's called the VIX, and it's famously known as the fear gauge. In this explainer, we're going to decode what this powerful index is, how it works, and what it's telling us right now. To really get why the VIX is so important, I want to take you back to a moment of just pure chaos, a time when fear had a complete and total grip on the markets. All right, so the date was April 2nd, 2025. The trading day ends, everything seems normal, and then, boom, an announcement comes out of nowhere about sweeping new tariffs. It sent these massive shockwaves through the entire global financial system. And right there, the fuse was lit. Just 2 days later, on April 4th, that anxiety turned into outright panic. The selling just accelerated like crazy. The S&P 500 plummeted almost 6% in a single day. A full-blown trade war seemed like it was about to happen. And get this, over $6 trillion in global market value was just wiped out, gone in 48 hours. And while the market was absolutely tanking, the VIX did the exact opposite. It exploded. On April 8th, it peaked at a closing value of 52.33. That's a level of extreme fear we hadn't seen since the pandemic crash back in 2020. So this all brings us to the big question, right? How on earth can one single number so perfectly capture the collective anxiety and panic of millions and millions of investors all at once? To answer that, we're going to have to pop the hood and see what really makes the VIX tick. So let's break down what this thing actually is. Okay, so that's the official textbook definition. But the most crucial part is right there in the middle, forward-looking. See, the VIX isn't measuring what already happened. It's a forecast. It's calculated using the prices of S&P 500 options, which are basically bets on where the market's headed, to figure out how much traders expect the market to swing over the next 30 days. The VIX wasn't always this powerful. It actually got a huge upgrade back in 2003 that changed everything. The original VIX from '93, it only looked at a really narrow slice of options on just the S&P 100. But the modern VIX, the one we use today, looks at a massive range of options on the much broader S&P 500. That gives us a way more complete picture of what the entire market is thinking. Okay, so now we know what it is. Let's get to the fun part. What do these numbers actually mean, and how can you and I actually use them? Think of this table as a guide to the market's mood. If the VIX is chilling below 15, that suggests calm seas, maybe even a little too calm, complacency. That 15 to 25 range, that's your normal, everyday market noise. But once you start creeping over 25, anxiety is definitely building. And above 30, that's red alert, extreme fear, major uncertainty, just like we saw back in that April 2025 panic. All right, now here's a really cool pro tip. The VIX number you see on TV is an annualized number, which can feel a little abstract. But there's a super simple way we can turn that into a practical daily estimate of what the market's bracing for. Seriously, it's a dead simple 3-step calculation. You just take the current VIX number, divide it by about 19.1, that's the square root of the number of trading days in a year, and bingo, that's the expected up or down move for the S&P 500 each day. So if you see a VIX of 28, the market is basically pricing in a daily swing of around 1.46%. It's a fantastic tool for getting a real feel for the risk level. But the VIX gives us more than just a number for the daily move. It has this really fascinating, almost dance-like relationship with the market that can tell us even more about what's going on. The classic rule of thumb, the one thing you have to remember about the VIX is this. When stocks go up, fear and the VIX tend to go down, and when stocks fall, fear spikes and the VIX shoots up. This inverse relationship is so strong that it holds true about 80% of the time, 4 out of every 5 trading days. It really makes perfect sense, right? As the S&P 500 climbs higher, people feel good. They're confident. The demand for insurance, in the form of protective options, goes way down, and that causes the VIX to fall. The exact opposite happens during a downturn. It's this constant seesaw between greed and fear playing out in real time. Now, this relationship builds into a more advanced idea called the VIX term structure. It sounds fancy, but it's just a way of seeing how the VIX is expected to behave over time. Most of the time, the market is in what's called contango. That's a normal, upward-sloping curve. It means things are calm today, but we expect more uncertainty down the road. But during a panic, the whole curve flips upside down into backwardation. That downward slope means fear is extreme right now, and traders are desperately paying up for immediate protection. It's a market screaming for help. So let's tie all of this together with one final concept that really gets to the core of what the VIX represents, and that's something called the Volatility Risk Premium. So here's the wild part. Over the long run, the VIX has consistently overestimated the actual real-world volatility that ends up happening. This gap, this spread between what's expected and what's real, has averaged over 4%. So the big question is, why? Why does this premium exist?
Well, the VRP is basically the price of insurance. It's that simple. Investors, as a group, are willing to systematically overpay for options to protect themselves from those sudden catastrophic crashes. And the people selling those options, well, they demand that premium to take on that risk. It is literally the cost of peace of mind.
And that leaves us with the ultimate question, the one every investor has to ask themselves when they look at this powerful gauge. When you see a low VIX number, are you looking at a market that is genuinely stable and full of confidence? Or are you looking at a market that has become dangerously complacent, forgetting that fear can and will return in an instant?